name's Chris Tyrrell. For those of you who didn't hear me introduce myself yesterday, I am the CEO of Offerboard, which is a Title II platform doing private placements under the Jobs Act that's launching next month. I am also on the board of the Australian Small Scale Offerings Board, which is the oldest small securities offerings platform in the world. Has been operating in its current form since 2007. They've had a law that permitted its activity since 1997 that they started lobbying for in 1984. So it's been a longer road for crowdfunding in Australia than perhaps we've had in other countries in the world. And I serve as the chairman of CIFRA, which is the regulatory advocacy organization for platforms and other constituents that will be doing work under the Jobs Act. So today I'm going to talk with you about U.S. market activity, the data regarding existing U.S. market activity under Title II of the Jobs Act, which is the only crowdfunding-ish, and I say ish intentionally, part of the Jobs Act that's currently in effect. Many of you know that the draft crowdfunding regulations are still draft crowdfunding regulations. That's Title III of the Jobs Act. They have completed their comment period, and we are anxiously awaiting final status on those from the SEC. With respect to Title II, part of Title II went into effect, and it was a very basic change. It said that private placements could be solicited generally if you verified that all the investors that invested in that particular round were accredited investors, and that you gave up the 35 unaccredited investor exemption that existed under the prior 506D. And they added a checkbox to the form. So now you can check a box. So that's what our first data set is about, is the checking of the box. So there were $27 billion in filings of Form Ds through the end of last year under Title II of the Jobs Act. And if you look up here at the graph, you'll see that about $3 billion of that was from companies, about $4 billion of that was from funds. Then there was one very large outlier fund that was $20 billion, $8 billion of which had been funded, and that led to a total of about $28 billion that had been funded, that had been offered under Title II of the Jobs Act in whole or in part. And again, one of the things I should probably caveat is this data set there isn't a lot of data in this data set. The Form D doesn't give you, for example, a good way of parsing what industry everybody's in. You have to guess from the names of the companies what industry someone's in and what they're doing. It doesn't give you a good way of identifying which of the exemptions they're using for a particular part of the raise. So some of these checked both box 506B and 506C. And maybe those were conversions from B to C. Maybe they were going to use B for a little bit and then convert to C. So 506B is the old 506 private placement that's not generally advertised. And once you convert around from a B to a C, you can't go back, but you would still file a form that showed that you actually raised under both exemptions. What does it look like today? Oh, clicker. So the ground has shifted a lot in the last quarter. So this is through the end of March. Now you have $55 billion in company offerings. You have $27 billion in funds, and a lot of funds did amendments to their filings that have skewed the $4 billion data. I think that number's bigger, and I think we're going to see some corrections in the next quarter that actually cause funds to exceed company offerings. And then there's still that outlier fund, but look, it's become much less significant. So now you're talking about over $100 billion in offerings, which is fully 1/10 of the overall private placement market that's been offered in part, in whole or in part, using 506E, using what some people call accredited crowdfunding. So that's exciting. We're diving deeper into this data. We're trying to use this data to make our platform more effective, and I think people are going to find novel ways of using the way in which these things happen to make it easier to achieve private placements using platforms in the future. State crowdfunding laws. We've also seen a lot of expansion here. I was talking with Brian earlier, and we were going, what is there? There's 6 or 7 as I was putting together this map. And there are now 6 states that have existing crowdfunding laws, 1 state that has a law that's going to go into effect in July, and 3 states that have laws that still need to pass one or the other houses of the state legislature. So state crowdfunding laws look a lot like Title III of the Jobs Act, many of them, with significantly lower regulatory burdens, and none of them have audit requirements until you're raising more than $1 million. Some of them are, all of them are capped at $1 million unless you have an audit, and then several states allow you to raise $2 million if you have audited financials. This is a significant shift in the landscape, and we hope will create some pressure on the federal regulators to move things along, or they're going to lose to a federalist experiment in states not waiting for the federal government to get their act together and enacting laws themselves. Most of these laws rely on investor definitions from Reg D, so there aren't going to be 2 different standards for investor qualifications for most of these states, and they have significantly lower filing and reporting requirements than either the pre-existing state exemptions or the federal exemption. So in other words, if you're raising less than $1 million, they might be significantly better for you. And John, are we going to do questions as a group after? So we're just gonna go. That's all the data I have. I hope I didn't fill your head too full. I can go into greater detail on state regulations, or I can go into greater detail on the Form D data during questions. But there you go. Thanks for listening.
Thank you, Chris. And Chris, one question. What was the amount of total filings made?
Total filings?
For 506C. And then of that, so when you file, you don't have to have the raise filled. So then below that, do you know the number in 2014 of completed raises that have raised 100%?
The chart showed that 30-something billion of them had been
Completed. Fantastic. Okay. Well, this is Brian, who's going to talk about regulation of equity crowdfunding in Canada. And if you think it's complex here, wait for it in Canada.
Great. Thank you very much. Good morning, everybody. I'm glad to be here and not where it's colder in Canada. We chatted yesterday about crowdfunding in Canada and what's happening there. And let me start off with, I'm Brian Koscak. I'm a lawyer at the law firm of Castles, Brock & Blackwell in Toronto, Ontario. I'm also the chair of the Private Capital Markets Association of Canada, as well as a newly formed co-chair, along with Oscar Joffrey, of the Equity Crowdfunding Alliance of Canada. And I say that separately in terms of crowdfunding because in Canada, I think 2 communities are evolving in terms of existing dealers trying to understand what crowdfunding is, which I'll get into is selling securities on the internet, as opposed to crowdfunding, the Jobs Act model. It's nice to split it up here when you talk about Title II, Title III, then everyone has a common vocabulary. Unfortunately, we don't have that vocabulary, so we kind of have to improvise. So that's a standard disclaimer. These are my own personal views and not necessarily the views of my law firm or our clients. So now we'll get into the guts of it. Crowdfunding is legal in Canada. Many people don't know that. It is legal in Canada. So what does that mean? How is it legal? It is legal in Canada in that you're selling securities over the internet through existing prospectus exemptions through a registered dealer. So I think here you're thinking of a registered dealer such as a FINRA member. The equivalent in Canada would be what's called an IROC member. They're the equivalent type of category. But in Canada we have something less than a FINRA member or IROC dealer called an exempt market dealer. And they are registered with the regulators, and they can raise capital as an intermediary in the exempt market where you do private placements, etc. And they can raise capital under 2 exemptions. There's any exemption they can, but 2 I want to focus on today is the credit investor exemption, which you're all familiar with. Let's say think Title II here. And you have various portals Jonathan identified that are doing this, as well as a second exemption, which is very interesting, is the offering memorandum exemption. And the difference between the two, we're actually having a discussion this morning, is, who is the crowd, and can you call something crowdfunding where they're not really the public? So if we look at accredited investor crowdfunding in Canada, they form 4% of the population. 96% is the public. Under the offering memorandum exemption, that gets quite interesting because it simply involves the prescribed form of offering document and a risk acknowledgement form. And if you give that to an investor, you can raise capital. And there's two models, which we'll get into. One's a British Columbia model, and the other is what we call the Alberta model. This is not offered in Ontario. So we're kind of like Europe, or if I looked at Chris's presentation on intrastate crowdfunding, like what's one state doing? That's kind of you have to look at Canada because we do not have a national regulator. There's been actually recent press that they're trying to come forward with a national regulator of sort, but it's not going to be anything like you have here. So what happens is the regulators work together through what's called the Canadian Securities Administrators, and they try to nationalize, meaning that we have an exemption that's across Canada, but also the bigger goal, which people like me like, is when it's harmonized, when it's the same. It's not split up and having different categories. So the difference is the offering memorandum exemption is to the public through a registered dealer. And that's what makes this quite interesting in Canada. So that's just a map in terms of the legend is available, proposed, and not proposed. So this is the credit investor exemption. Again, if you look at individuals, it's wealthy individuals. They have net income and asset tests, just like they have here in the States. And many times we follow what is happening in the States. And right now in Canada, they have out for comment a review of the credit investor exemption. They were thinking of indexing it. They're not going to index it. They're looking at adding more risk disclosure forms, if anything. So that's pending review. The offering memorandum exemption, as I talked about, there's the British Columbia model, and then there is the Alberta model, and then Ontario is green, which it hasn't accepted it. So we're pretty excited that Ontario's now looking at this, and we'll get into a slide of how that is evolving. The big difference is in the Alberta model is they can raise up to $10,000 per investor, and after that you have to be an eligible investor. And what does that mean? A baby accredited. That's one way of colloquially referring to it. You have income of $75,000 a year or $125,000 for you and your spouse in the last 2 years, and you anticipate that you will continue having that. So it's a lower threshold. So that's the two models. So you can see there's a certain number of provinces that are following the BC model and a number of other provinces following the Alberta model, and then you have Ontario that's looking at it. Hopefully you're following me. I've included a chart there on your table as more of an infographic to kind of leave you with, their slides are here as well. Okay, so who's doing this in Canada today? So if I put on my exempt market dealer hat, we have Seedups that is working with an exempt market dealer. So they're like a brand, but they're working with a registrant together. They're not registered, but together investors are protected. And there's Optimized Capital. They are registered as an exempt market dealer. And I think there was a recent popular transaction that Woody Harrelson was actually involved in some capacity, I think as a shareholder, which they just closed out the round. So they are, when you go on their portal, selling securities on the internet, and then if it's accredited, they have to verify that they truly are accredited, or if they are a member of the public, they have to satisfy other requirements. So what happened not long ago, a couple weeks, these are the 4 new silos that are happening in Canada, which is pretty exciting. The comment periods are ending in June, so it's out there now. And the first one is the startup crowdfunding exemption. That is something very interesting. Crowdfunding for startups is legal in Saskatchewan. And I'm not aware of any portals there yet, but that is a model that they looked at. It's, we'll get into some of the features in a moment. The equity crowdfunding exemption, which follows the Jobs Act, I call that the SME exemption, more for if you move up in the silos, the small and medium-sized enterprises. And then the offering memorandum exemption and the credit investor exemption, again, through a registrant, you can raise large amounts of money, and there's lesser or no restrictions on how much money an investor can invest. So this is the proposed equity crowdfunding exemption. In December 2012, Ontario came out with a model, just Ontario. And between now and March, a number of other jurisdictions, including Quebec, have come on board in terms of looking at it. It's not legal yet. But some highlights, which we'll get into, is in terms of how much you can raise, is about $1.5 million any 12-month period, and $2,500 per deal, and no more than $10,000 per investor. So you can see that you have the income thresholds here, the asset thresholds, and the dealer has to look at how much you make, etc. They're not doing that there. They're just giving a flat amount that no more than a certain amount. So this is the startup exemption. Ontario is not part of this. So there's philosophical differences amongst the regulators of how they want to protect their investors. And the portal in a startup exemption is not registered. So that's that you can see that could be a sticking point for certain regulators. But you can also, we talked about the ease of capital is what is the right balance in terms of what is that burden of raising capital, the cost of capital on how much you're raising versus trying to protect investors. So the twin mandates of the regulators in Canada is always fair and efficient capital markets as well as investor protection. I won't go through all of these. These are just kind of some of the highlights comparing the startup to the equity crowdfunding to the offering memorandum exemption. A couple interesting things is if you look at public and private issuers, you can do both under the offering memorandum exemption and you can do both in crowdfunding. I think Chris Tyrrell, I don't think you can do public companies crowdfunding in the States, correct?
No, public companies can do Title II.
Title II, but they can't do Title III. Okay, thank you. You can do that in Canada, which gets interesting. So we talked about the limits here. The startup one, it's $1,500 per investment, no more than $300,000 in terms of a cap, in terms of how much a company can raise. The crowdfunding one is $1.5 million. There are caps of $2,500 up to $10,000 for investors. The offering memorandum one, those are, there's that $10,000 cap. I won't confuse you, but believe it or not, I talked about two models, the Alberta model and the British Columbia model. Well, the regulators have further dissected this, and we have splits amongst provinces in looking at this eligible investor. So now we have two models that are current and another two that are under review. So you have to kind of follow the bouncing ball. Hopefully we can get them all to agree, but I think what they're trying to do is figure out how these investor caps work, who is an eligible investor, who is not, and that's they're going to get a lot of comments from people in terms of what their views are. So in terms of financial statements, real quick, that's always a hot button. In terms of equity crowdfunding, if you raise more than $500,000, as well as they have another financial threshold is if you spent more than $150,000, it will trigger audited financial statements. In the OM exemption, you have to have audited statements. So you can see the cost of capital is going up in terms of more how broadly that the exemption is available. And when you sell securities in Canada, it's called a closed system, that you can only resell them under another exemption. So part of the challenge is, even though you see a lot of people then will be participating in crowdfunding, there's no liquidity. So what's interesting is, I think 2 weeks ago, the TSX announced that they have developed a whole private capital markets division, and they are talking about developing a secondary market in the private capital market. So there's not much information out there yet, but it's quite interesting that you have a large actor such as that is trying to get involved in the secondary market trading of securities for private companies. So just to be clear on intermediaries, the startup has no dealer involved. There's registrant. The equity crowdfunding has to be registered. Remember I talked to you about the exempt market dealer. Consider that the equity crowdfunding portal is exempt market dealer light. There's a number of requirements, but it doesn't have to comply with all the requirements. And the offering memorandum exemption, you can use a dealer or you don't have to. It's not necessarily a requirement. So to sum up, 4 ways to crowdfund in Canada. There's accredited investor crowdfunding. There's the offering memorandum exemption. There's the proposed equity crowdfunding exemption and the proposed startup exemption. In terms of what are the cross-border opportunities, that's what interests me. I think there is really, really interesting opportunities between U.S. portals and broker-dealers working with portals and exempt market dealers in Canada. And I think if you look at an issuer trying to raise capital, there is always a concern that if a deal comes north, like why is it coming up north? Like why isn't it being funded in the States? But if you have actually a portal that can put a deal online and is doing it in a compliant way in Canada with a portal and in a compliant way within the States, you're just looking at, the issuer just wants to get funded. I mean, there'll be some cross-border issues, but it provides an interesting perspective. It allows issuers to raise capitals in both jurisdictions, as well as, and more importantly, there could be other reasons why they want to have investors on both sides of the border. So I'm sitting in Toronto, here we are in Silicon Valley. I'd love to have the opportunity to look at some deals in Silicon Valley that I'd never see. And if you're in the Valley here, or you're in New York or Texas, wouldn't it be interesting to see some cool tech deals out of Toronto, Waterloo, or even some oil and gas deals out of Calgary? It gets really interesting, and I think that's where people like myself see the industry going. That's it. Thank you very much.
Well, thank you, Brian. So I think we're going to do a quick panel, Q&A panel with Chris. I think Brian, you want to come back up?
We're going to take a Q&A. Any question from Jay, from Tyrrell, while you got him here? Okay, I'm going to start with the first question myself. When do you think this kind of actually Title III is going to happen? When do you think?
Labor Day. That's my vote.
Jay?
The votes in CIFRA were everywhere from Memorial Day through never, with the biggest never vote just being next year, but I have no idea when. So there's a range.
Jonathan?
I say late summer, and I'll hedge that by saying I have no clue, because people placed bets last year, and I will say that the SEC is on their own timeline, and they continue to show that.
Jay, $1 million cap. Do you think big players are going to come to this? I mean, institution, enterprise?
One favorable thing that the proposed rules do include that you can run concurrent offerings, so I'm not as worried about the $1 million cap. I am much more worried about other issues that hopefully can be ironed out. But so, for example, Chris's platform, it'll be able to support a crowdfund raise as well as a 506c raise. So if you want to raise $5 million, you can do $1 million from the crowd, non-accredited investors, plus $4 million from accredited investors.
Microphone. I'm going to give it microphone here. Jay, well, I'm going to sit right here. Yeah, please. Thank you. Okay. So, do you think we're going to have a combination 506c and Title III together and combine? That's going to happen?
I think we'll see very little Title III activity starting out. I mean, that said, we really have to wait until the final rules. But if I'm an issuer and I look at the hoops I have to jump through to do a Title III raise versus the hoops I don't have to jump through if I do a Title II raise, I would tell all of my friends personally, don't touch Title III. If you have access to capital through Title II. Longer term, I'm very optimistic. We're seeing the interstate movement. We're increasingly seeing proof points from abroad. We're going to see federal regulations work. I just think it's going to take a little longer than some people expect. I think we're going to see most of the traction and most of the liquidity in Title II markets.
Okay. Brian, anybody has a question from Jay? Just while I'm asking Brian, because this is different. When the law, and I call you.
Aren't you going to ask me when
I'm going to ask
Title
you
III
a
and
question.
Title II is going to come into the States?
No, I want to ask you about Canada, which I like it much better. I mean, you guys have that $300,000 cap without even portals registry. What is it all about?
It's interesting. Many people have different views of that, so you can appreciate not having a portal registered at all.
Yeah.
You can see the OSC has not bought into that yet. I mean, I'm not privy to their discussions, but I know that there's other provinces have not bought into that, because the concern here is whether it's $1,000 or $300,000, the system has to be in place. But in fairness, as someone, we discussed this the other day in Toronto, is like, well, who do you think is going to invest for $300,000? Like, you can't put this huge burden and you have to balance out the cost of capital. At the end of the day, a startup of that nature, what do they have other than a PowerPoint, a very simple business plan and idea? And more often than not, you're investing in management, the people. So many people believe that it will end up being family and friends online that have an affinity to that particular startup. But they don't necessarily think that the crowd's going to drive in because it's just too raw. But I think what's really exciting in Canada is that you need that part of the ecosystem to raise capital. I mean, a lot of companies are startups. They start and then they grow. So if you're not going to even deal with that level, like once they exhaust family and friends, where do you go? And they're not going to go to a dealer because they're too small for a dealer. So something like this, you can see it makes sense in the ecosystem.
Okay. Well, Chris, I want to ask you a question, and because I know you travel and you know, like I know in England they have crowdfunding, and so does we're going to have here from the Alexander in Italy, and a lot of countries around the world, in Australia that you have connection actually. A lot of countries like England, they went ahead, then stepped backward. Now we have seen Canada's happening. And in Australia's models work. So what's going on in the U.S.? What do you think? What are they waiting for? I mean, what is all about? Are they going to? What do you see in the overall of crowdfunding in the ecosystem all around the world?
So I think there are a couple things that are starting to happen that people were waiting for. One is activity in the Title II marketplace. People are actually getting experience doing general solicitation, and I think that's going to change people's attitude towards it because we're going to start to have data around it. We're going to start to have success stories about it. With respect to the delay with Title III regulations, you have to realize we've had 4 SEC commissioners since the law was passed, and that there's some time delay when you change the head of an organization, and it takes on the character. And we had at least 2 of those that actively did not want a crowdfunding law. So there have been some delays that have just been regulatory inertia. But what's changing now, and what was never the case, was that the SEC staff was antagonistic to the process of getting the actual work done necessary to write the laws. In fact, I have never seen a government process in which the people who are writing the regulations are more attentive to industry's needs and attention than during this process. The regulators were incredibly accessible to the industry associations and people who took the time to write comment letters who weren't part of the individual associations. They spent a lot of time really trying to figure out what would work best and really balance the interests of investor protection with the interests of getting the marketplace started. That said, the only step that's left is they have to summarize all of the public comments for the commissioners and make recommendations as to how the regulation should be changed to conform with those comments, and then the commissioners have to vote on it. So that's what we're actually waiting for now with respect to Title III, is for them to finish the synthesis of all the comments that were written, present it to the commissioners along with staff recommendations, and the commissioners have to vote on that, and then they have to vote whether to take it through another review process, which they could do. If they change the law significantly in between the draft and the final, they could send it through an entire new comment period, or they could release it as an interim final rule, which means you can start using it, but we might change it, or they could release a final rule. So there are still several pathways out of getting Title III implemented, and again, it's reading tea leaves. It's anyone's guess as to what they're doing. However, the chairman did say under inquiry from Congress that this law would get out this year, and while the SEC has missed deadlines, I have not seen Mary Jo White miss a deadline that she promised to Congress yet. So I'm hopeful that we will get them by the end of the year.
So there are a lot of people that they were kind of come from overseas, set up shop here. Companies that I met them here, they come visit, like Crowdcube and Cedars and other people over there. They kind of step back. I mean, everybody going their own, doing stuff actually back home. And now Canada's more aggressive proposal. So what are we waiting? Do you think we're going to next year this time? And a lot of people, by the way, they're talking about Title IV now.
Yes.
I mean, and what is it all about? I mean, I want to ask Jonathan, what is Title IV? What's it all about?
Yes, so Title IV is Reg A+. And I'll probably actually defer to Chris on that because there's still, so what we're waiting on to see if in the Reg A+, they provide blue sky exemption. So if they provide that, it could become a viable vehicle to do crowdfund raises less than $5 million in a very low-cost way. So Chris, are you guys working on a Reg A plus fundraising product?
So we're not working directly on a product, but we are talking with a partner about a marketplace for Reg A plus transactions. Regulation A plus could potentially be the most significant aspect of the Jobs Act. It's very underappreciated. It changes the small public markets, people who are raising less than $50 million from the public in unlimited amounts of investment by any individual. There are no individual caps. These are public shares. They can be traded publicly. And the SEC used a very creative way of giving them blue sky exemption, because that was what everyone always complained about. Yeah, sure, Reg A Plus is great, and it's a lighter version of regulation with respect to an initial public offering, but you have to individually conform to all of the individual states' blue sky laws. What they did was they used a definition that they had previously used to carve out larger funds and people with greater investing capacity, called the qualified purchaser. And they just changed the definition. In Reg A Plus, it says, if you buy this security or if you sell this security, you are a qualified purchaser. And they used the exception in a way to break the rule, or so NASA, the Association of State Securities Administrators, which is somewhat chagrined by this change, is arguing, or has hired a lawyer to argue, that they overstepped their bounds, that they're not following congressional intent. Now, I've gone back and looked at the way in which Congress wrote Title IV of the Jobs Act, and I don't think you can tell whether Congress intended those to be subject to state blue sky laws or not. The intent of the entire act was to free up capital formation. So that'll be an interesting set of arguments to see how it plays out. Right now, the way it's drafted, you can raise $50 million publicly with limited public reporting and compliance regulations, as was intended with Reg A in the first place, up to $50 million from the public, unlimited amounts of investment by any individual without blue sky compliance. And that would be a very significant change in the small public markets. You would see a significant change in the number of public companies in America, and you would see a significant change in the way in which those companies go public.
So just follow-up question. After the Title II pass, how many deals has been done? I have some number. Anybody has any numbers?
How many deals were filed under Title II?
Well,
From September 23rd to December 31st, 426 companies, not funds, filed Title II Reg D forms, which means you file those forms 15 days after you take money or after someone is irrevocably committed to take money. So 15 days later, you have to file that form. And so 426 companies filed that form in that time period. I don't have the number for the last quarter, but I imagine it's probably about twice that. So you've seen over 1,000 companies apply for Reg D.
You want to comment on that?
Actually, I wanted to take the opportunity to ask Chris a question on
Sure.
that. No trick question, but just because.
But I want the audience to ask questions.
Yeah.
While you got him over there,
I guess we're the
here,
panel.
ask some Canadian question.
The
You know,
panel's asking the
and
panel.
give it back to him. He called me when Canada won. He said Canada won, USA 0. So give him some hard time for him.
Is there
Hockey,
opportunity for
we're
Canada?
How are the Maple Leafs doing?
Did we not win the Olympics? Sorry.
Was it losing
these guys-
eight in a row or something?
Yeah, I'm going to be a Harvard Cassell soon.
Exactly. All fair points. Chris, under Reg A Plus, are there some opportunities for Canadian companies in the legislation?
Yes.
If you could
In fact, it explicitly says you can be a Canadian registered company and do a Reg A Plus offering.
Okay, because I think for those that'll be listening to it on the video, that would be important, because I've had some inquiries from Canadian issuers. They're trying to figure out how does Reg A Plus help them, and they're getting kind of excited, but they don't have all the details.
Any question from Mark has a question, but yeah, please.
So under Reg A, current Reg A,
He doesn't need a microphone. He's got that great voice.
Under current Reg A, public trading is not required. So the company or the broker-dealer can make the offering, raise the money, it could be growth capital, and the investors might not have a liquid market. What's the status of the regulation A+.
It's not required, but there are several groups that are trying to create an ATS or a joint ATS structure, an alternative trading system is a particular registration category with the SEC that allows you to trade all kinds of assets, and people are trying to set up different ATS and BD structures to create a marketplace in which those would trade. Because really, it's not tradability from a practical standpoint, whether you can execute those trades. It's really making sure buyers and sellers have a known location to go transact, to post those deals. Because right now they're done the way private transactions, it's kind of hunt and seek to go find a buyer. And so those are, and frankly, I mean, even pre-IPO companies sometimes have trouble. I mean, there have been 3 pre-IPO companies that have called the brokers affiliated with Offerboard recently with large blocks of private shares trying to market what are currently hot securities, and they're having more difficulty than normal finding buyers because that illiquid market, since Facebook and Twitter, has not had a significant amount of activity. I mean, Second Market had to change its business model in order to deal with the fact that once Facebook and Twitter stopped exchanging hands all over the place, those markets, even in the pre-IPO private markets, slowed down significantly.
Does anybody has the question about, and as you brought a good point about this Facebook, thanks, about the Facebook and buying to Aquala and
Oculus Rift?
Yeah, and that's going to bring a lot of issues, and we have a couple of.
Well,
I know a lot of
Jonathan
lawyers.
was nice enough to punt a question to me. I'll punt the Oculus Rift question back to Jonathan.
Yeah, please, Jonathan. What's going to happen? I mean, I'm going to ask you. What is it going to be opening up? I know we have a lot of lawyers in the house right now, and that's what's going to happen basically when they invest on these companies. And all of a sudden, Facebook or Google, any of these companies, they come and bought them out, which is a great thing about crowdfunding. That's what it's all about, market validation. You go to the crowdfunding platform, you do demo and pitch, and if somebody wants it, you guys have that. If it's investment, what do you think is going to happen right now with this, rewards and all these things are happening? I mean, that's very interesting.
Yeah, I mean, I think it's, by no means do I think what Oculus did was illegal. Of course not. People knew I would say, if you expect people to understand security law, then yeah, they should have known. But most normal people do not understand security law in the same way that I know nothing about medicine. And I think what it showed is that what we're seeing in the private capital markets is enormous wealth creation that's inaccessible to 98% of America. And so you look at Kickstarter, this has happened not just once, multiple times. The same with the Pebble Watch. It went from being validated by the crowd. So the earliest risk takers were individuals, effectively pre-validating that, but they see no financial upside. Obviously, now that category is going to be enormous. In Title III crowdfunding or whatever exemption is used, it really requires, though, democratic crowdfunding, because that type of product, you need that cap table of 10,000, 20,000 people who can invest as little as $10 or $15. And so of the major rewards platform, Kickstarter is decidedly not touching investments, or so they say. I believe it. Indiegogo will, in my personal opinion. I mean, they've been pretty proactive about being involved in the legislation process, and I see them doing it. And Rocket Hub will probably do it as well, and of course, all these other platforms. And so the question is longer term, looking at Kickstarter, does it become viable for those larger raises? Because if they have an opportunity to get a free product or actually participate in the upside, I think a lot of people, if it's easy to do so, are going to say, I'm taking my dollars to investment. And even if I own 0.00001%, it's psychological. It's different when you actually own a piece of it. And now we're seeing, just to be honest, like they deserve that opportunity. They took that risk.
So you think they deserve to get part of that cut of that $2 billion?
No, absolutely not. No. So by no means do they deserve any part of that $2 billion. They were not shareholders. What Oculus did was entirely legal, but just because it's legal doesn't make it right. Oculus, 2 weeks before they sold, they said we're not going to sell. Oculus raised capital on building and giving them a consumer product. They never delivered on that. The least they should have done is delivered that product. And then if they decide to sell, what Facebook should have said, to be honest, is we'll pay back anyone who wants it. Now, to be honest, that would kind of be a submission of weakness, but it probably would have been the right thing to do. The interesting thing about Kickstarter is they say time and time again, we're not a store. they are a flipping store. You look at all of their largest projects, they're all products. It's people pre-buying products. And so as much as they want to whitewash and say, we're not a store, that's the function that they've become.
I wanted to add to that, if
Sure.
I may, Sydney. My son is kind of in this gaming community, and I found out about Oculus through him. And as you know, I'm a lawyer, and at the end of the day, you listen to these compelling arguments, and at the end, as you said, you come up with, it doesn't matter, it just ain't right. And I think that's kind of what you're left with. I wanted to ask you, the crowd, through crowd intelligence, how many think that at the end of the day, what happened here just ain't right? Maybe put up your hand.
Yeah. So you guys think that they should get a
Or do
part
you
of the
think
pie?
what happened here is okay and there's nothing about not being ain't right? Interesting. Okay. So it's kind of like a mixed crowd on that. But I think at the end of the day, I look at this as Oculus is that hockey stick growth opportunity that should have been happening in equity crowdfunding. And that will be the hockey stick growth company that will people will see and get all excited about crowdfunding. But there'll be many companies that have failed and didn't get anywhere. So you have these few success stories. And at the end of the day, what I really found interesting is if you look at the engagement of the community and the social media, and this was right and this is wrong, this is awesome crowd dynamics. That they're all weighing in and no one's right or wrong in looking at something and saying, here's a company that went to the next level and are happy with it. But as Jonathan said, there's just something about it that it wasn't fair that people can participate in those billions of dollars.
Yeah. And this is very interesting. And Jonathan, you mentioned all about the flipping, and Kickstarter. And we do have an article just recently in Crowdfund Beat in our magazine. It's called Rise of a Pre-Commerce. That's what's happening. A lot of products, they come and they put in the platform like Kickstarter, Indiegogo, and Rocket Hop. And if they get enough attention from the crowd, and yesterday we had those panels about movie 2 of Veronica Mars. So they don't want to just kind of do a spray and pray mentality. They bring them to the platform. If they get enough attention from the crowd become in a Facebook, they become a little PR and big PR. So they stay with the crowd, and that's what basically, and you know a lot about, that's what go back to that mentality of, how successful is Circle Up is just invest in what you believe, invest what your products, what you do. So what is your thought about this?
Yeah, I see people investing for one of two reasons. One, as a financial asset class, and two, it's something they know. So Oculus is a great example. It's something that they had the demand, they had the need. They should absolutely invest in that, in small amounts. But the largest amount of their dollars, if you look at how many dollars we invest in the portfolio, I would say that's 30%, maybe 70% will be as a financial asset class. And if they're investing as a financial asset class, my belief is that they'll invest through funds, a fund approach. Because the average individual is not going to create accounts on 10 platforms, do due diligence on individual deals. And so we'll have both. And so Circle Up is obviously saying...
Yeah, you know all about Circle Up. Tell me why they're so successful. They are very successful. No, and by the way, they don't just let anybody come to their platform. They're very careful about that.
So Circle Up is built on the premise that you have a population of companies, consumer product and retail companies, that they're doing $1 million plus in revenue, typically less than 15 million. They're not sexy enough for venture capital. They're not going to provide those 100x returns. They're not big enough for private equity. So if you look at private equity funds, you look at the lowest tier, micro-cap private equity funds. I worked at One Riverside. They don't really look at companies unless they have 5 million EBITDA. So you're looking at minimum revenue of 20 million. So you have this whole population of companies who've been underserved in growth capital. Ryan Kalbeck comes from consumer investing. He worked at private equity. He went to conference after conference after conference, and all these smaller companies were saying, we need capital. And he would say, we can't help you. We don't even know who to refer you to. There's no one out there. So they're building a marketplace that's saying, how do we fund these companies? And they're making that market. Now, right now, they're doing smaller transactions. But what we're seeing is that they're learning how to do transactions in incredibly efficient ways. So they're ironing out every efficiencies they possibly can. And the natural evolution of that is they'll begin going up market. So right now, their average transaction size is around 775,000, but they've done a couple 2 million. There's no reason why they could not do a $10 million transaction in 2 years. And that's when they start to displace traditional private equity funds. They're like, oh shoot, you're coming up in our area. In the same way that in the UK, Funding Circle, debt-based platform, they started doing loans, $250,000 was their max. And they moved up to 500,000. Now they're up to $1 million. And we're going to see this everywhere in the space. And this is classic bottom-up disruption where you start, small transactions that no one really cares about, but you're realizing enormous efficiencies. And then so as you move up, you can do deals fundamentally lower cost than anyone else can. So that's something I'm excited to see. And we're going to see that across all industries, that model templated and pasted across.
So good. And so I wanted to ask another question, but I want to ask the audience, have any questions? Any from Jay? And by the way, I want to tell you, and grateful to Jay, Jonathan, and call him Jay. A lot of people call him Johnny. But I have not. He has great report in that Crowd Cafe. It's one of the very great intelligent publication. And you did report on Cedars. You had to report on the Circle Up. And I highly recommend it also for audience. And we do broadcast this in audience at home. They can go to the Crowd Cafe, crowdcafe.com, which is, I get those weekly, and I can't wait. This Sunday, is like before 60 minutes, I go and read your stuff. And I'm one of the fan here, I have to disclose here. And it's very intelligent, it's wonderful. Jonathan's one of the best people. Chris, how did the people try to get in touch with you if they want to know, tell us about what do you do basically? I know you're one of the experts in this crowdfunding, and this is the state of the crowdfunding. We're glad to have. How did they come to, what does your company do? And I asked you last night, actually.
So our platform that's launching next month is Offerboard. It's at offerboard.com. You can reach me at chris@offerboard.com. Our association is CIFRA, CFIRA. That's at cifra.org. And we invite you to join, become members, become advocates, comment. The people who comment on the regulations are going to affect the baseline regulation that will affect the way in which this entire industry operates. It's a really important time for us to engage government and see if we can get a set of laws that really make an operational marketplace.
And Brian, if anybody, I know we have Canadian print, and I have to recognize this. Perry here from Montreal, he has a great platform, great show over here. I think we have a question, and we started Bill has it over there. But we do have guests from, they come all the way from Italy. And this is what I'm proud of this conference we do every year is all about the people that they know about crowdfunding. And I do the best, and we do videotape, we send so people that can come. And I wanted it this way. I want to have intelligent crowd, intelligent people that they are in the business. We're grateful to have David Khorramshahi is coming here. He's very busy, I know that. And we have Mark. We have Michael Koscak, and he's one of our sponsors, and we have here in Carlo, and come all the way from, and we're very grateful for everybody out there. And I want to ask Brian, and we're gonna close for a few minutes and have a little break, and we're gonna have a next panel. We have a presentation from David Drake, and from Alexander from Italy, and we have Devin, which is no need to introduce. He's one of the wonderful people. So stay tuned. We're gonna take a break. I want to ask you a question. We're going to beat you guys in the hockey?
I think it'll be a very competitive game.
Well, I'm still in New York and living in New York City.
I'd say we'd lose.
All right, yeah. So I think. All right. Well, thank you very much. That's wrapped up our export. We appreciated your time, and thanks, Jonathan.